Why do high income earners, wealthy families, and even corporations put tons of money into life insurance? It always has to do with the cash value. Specifically, as long as we follow IRS rules, we can use that cash value tax-free. Over the years, I've been able to work with wealthy families, small business owners, and even banks in setting up their cash value life insurance policies. And what all of them express is that I like the cash value because it's a safe place to put my money and I really enjoy the tax benefits. So what we're going to cover in this video is what institutions, high income earners, and really anyone who's paying a lot of income tax, how they use whole life insurance and what they're attracted to. So typically where it starts is someone has money in a money market, maybe it's treasury bills, maybe it's bonds. They have their money in a safe asset class. They also have money in the market, real estate, and other areas, but funds that they have in a money market, for example, they might be earning 4.5% or 5%, but it's taxable. And if they're in the highest tax rate, they really feel that tax hit. So they look for alternatives, and life insurance often comes up. So typically what we'll see is someone will look at money that they have in a money market, maybe it's treasury bills, whatever, and they'll say, does it make sense for me to move some of this over to life insurance, especially if my goal is cash value? If so, explain to me why it makes sense. There's two reasons why it typically makes sense to them. The first has to do with the safety. So life insurance is one of the safest places you can put your money. You'll see that the cash value just continues to appreciate regardless of what's going on in the stock market, economy, doesn't matter. Over the past several weeks where the market has been tanking and everybody's panicking when they look at their cash value life insurance policies, just continues to go up. So it's a safe place they can put their money, and it's often better than what they're doing now. Now, when you combine that with the second piece, tax-free, that's where it really becomes attractive. Here's why. Someone might be able to earn 4.5% or 5% in treasury bills, or perhaps a money market. But if you can get 4.5% in a money market, are you actually earning 4.5%? You're not. Whatever your effective tax rate is going to have a major impact on your net return. So for example, if you're earning 4.5% in treasury bills or a money market, and your effective tax rate is 20%, this means 4.5% is what you'll earn on paper, but then after you pay federal income tax on that, you'll be left over with a net of 3.6%. If you're in a 30% tax rate, you'll be left over with a net of 3.15%. And if you're in a 40% tax rate, your net will be about 2.7%. You can Google search what is called a taxable equivalent yield calculator, and you can plug numbers in like this to see what a taxable equivalent yield will produce. You'll get very similar results to what you see here. Let's take a quick look actually. I'll show you something cool. I like to use this. Let's say someone says, I can get 5% in my money market over here because that's what's advertised. So you may get 5%, but after paying taxes, what are you left over with? Well, if we look at this example, which we have someone in a 10% tax rate, what happens? After taxes, he's left over with a net of 4.5%. What if he's in a 20% tax rate? Well, to get that 4.5%, he would need to earn 5.63% before taxes. And then after paying taxes, in his 20% tax bracket, he'll be left over with about 4.5%. And what you'll notice, the higher our tax rate is, the more we need to earn before tax in order to net that same 4.5% effective rate. Make sense? So, this is a big reason why we see individuals attracted to cash value life insurance. There was a couple I met with. They live out in California. The wife is a doctor, the husband's an engineer. They are in a high tax bracket. They have money in treasuries, and the wife expressed that the interest rate on the treasuries was attractive, but after she has to pay tax, she's like, I feel like I'm always getting nickeled and dimed. I just pay more and more tax. I don't like it. Whereas when I look at the life insurance policy, when I look at the net rate, it's about 4.5%. But because it's tax-free, I don't have to pay any income tax on it, which means I actually earn 4.5%. That's my net. So that's why she's attracted to it, and that's why they're looking to move some funds over to a life insurance policy. Now, with that said, does it make sense to move money over to a life insurance policy if I have funds in another asset? The answer is maybe. The question that I would ask if I'm you is, can I do better with a whole life insurance policy? The answer, in my experience, is usually yes, but there's a big but. One, the policy must be set up for cash value, and two, it must be set up where we maintain the tax advantage, because it is possible to mess things up with a life insurance policy and have to pay income tax on the gains. I'll go through a couple of examples. Let's go through the setup first. So firstly, setting up a policy for cash value. Here's what to look for. If you pay $1 into a policy, what I want to see in the first year is 85 to 95% of that dollar show up in immediate cash value. That means if I pay $10,000 into a policy, in the first year, I want my cash value to be somewhere between $8,500 and $9,500. If I pay $100,000, $85,000 to $95,000. Make sense? In most cases, we see it somewhere between 85 and 90%. That's step one. Step two, my break-even point. I want to look for somewhere between 3 and 5 years. That's typically the earliest we can break even with a whole life insurance policy where the expenses are pushed as low as we can possibly push them. And then number three, the company selection. I would always recommend one of the 4 major mutual companies, who are MassMutual, Guardian, New York Life, and Northwestern Mutual. The simple reason why is I've seen consistent proof of performance from these companies. Meaning, when I look at life insurance policies, the biggest form of buyer's remorse that occurs all the time is I look at an illustration, the cash value tells me I'm going to have $1 million 30 years down the road, and I end up with $700,000 instead. It under-delivers. No one likes that. Where I've seen policies deliver closest to the illustrations, and specifically where I see internal rates of return of at least 4%, in many cases greater than that, is with those 4 major mutual companies, MassMutual, Guardian, New York Life, and Northwestern Mutual. I've seen that to be consistent. That's why my comfort level is with those 4 companies. I remember years ago, a director at one of the largest life insurance companies in the world, this was for a stock company, he had met with another agency who had proposed a whole life insurance policy with a small mutual company. And his response was, there's no way I am flowing this amount of money through that company. He was looking at an annual deposit of $400,000. He was comfortable with the major mutual companies because of that proof of performance, and also what he knew from being in the financial services and life insurance industry for a long time. That was very important to him. Now, here's what I'll conclude with respect to this point. This is not always going to be the first option you're shown because it does minimize commissions. With any whole life insurance policy, with any company, small or large, if you see a first-year cash value between 85 and 90%, that means the base premium is pushed probably as low as it can possibly be pushed, which means the commissions are pushed as low as they possibly can be pushed. Next, when you look at the major mutual companies and compare what they pay in commissions to other smaller mutual life insurance companies, the major mutuals do pay less. Just when you compare the rates and what you're paid as an agent, you are paid less. So what that means is that the industry is incentivizing agents to sell products with companies that do not deliver, or at least cannot provide proof of delivering the highest cash value. So in order to get policies that have that track record, the agent is going to make more, which is beneficial to be aware of because there is an incentive there. The next piece, maintaining the tax benefits. So with a life insurance policy, why people like it is because they can access the cash value tax-free. One way to mess that up is if our policy becomes what is called a modified endowment contract, or a MEC. This can happen to any whole life insurance policy. If it does, you're taxed on the gains if and only if you access that cash value. Now you're taxed on those gains if you access the cash value through a withdrawal or a loan. There's no workaround there. Also, if you touch it before the age of 59 and a half, you also have a 10% penalty tax. Again, this only applies to the gains, not your principal. But it does mess everything up when it comes to taking advantage of the tax benefit that comes with whole life insurance. Now, on that piece, it is very easy to prevent a modified endowment contract from occurring. Every policy has what is called a MEC limit, which is simply the maximum dollar amount you can add to a policy per year without triggering a taxable event, and we can set that up front. So if I'm meeting with someone and they say, hey, I want to fund $100,000 per year because I'm moving money from my bank account that has 500 grand, I want to get it in here, what we'll do is just set the MEC limit at 100K. So they can fund up to 100K per year without triggering a taxable event. So a MEC is one example, easy to prevent. Another example, if we cash the policy out, if you say, I'm done with this thing, Steve, I don't like the advice you gave me, I don't want this policy, see you later, man, and you just cash it out, if there's a gain on the policy, regardless if it's a MEC or not, the gains will be taxed as ordinary income. Meaning, if you have paid in 100 grand and your cash value is $150,000, you cash it out, the $50,000 above the 100K you paid in, you've got to pay ordinary income tax. Not capital gains, but income tax. And then another example is if your policy lapses, which typically happens if I have excessive loans outstanding. This is rare with whole life. Where this has happened a lot in the past is specifically with universal life type products. But if I have a policy where I've built my cash value up to $100,000, but then I loan out $99,000, and then I don't pay the premium and I don't pay the loan interest, there's a very, very good chance that the loan interest is going to exceed the interest earned within the policy, which will result in it lapsing unless I pay something. And if it lapses, I'm taxed on the gains, similar to how it would work if I cashed it out. The difference with this is any unpaid loan interest also counts as a gain, which can result in a big tax bill if I haven't paid loan interest for a long time. Again, this is rare, but it's something that's beneficial to be aware of. So the main thing is we want to maintain the tax benefits. What I went through there is not meant to scare you. Your agent will take care of this for you. Typically, any good agent will. The insurance company, a lot of times, provides awareness as well. So this is so rare, but I do like to mention it because life insurance is often marketed just as tax-free, 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 which is not always, it's not the case. We do have to make sure we are responsible and maintain the tax benefits. So let's go through a few examples. We're going to look at some people that we are working with and have worked with for several years. First, we'll look at an attorney who serves as general counsel at a Fortune 500 company that sells some coffee that I drink a lot of every single day. And she's actually been funding her policies with $600,000 per year. Specifically, what she's been doing is taking money she's received from a deferred compensation package and putting a portion of that into life insurance because of the safety and also the tax benefits. She also has some company stock, but just in diversifying her assets, she really likes what the life insurance policy has done and what it's doing moving forward. Then we'll look at a hedge fund officer who is moving about $500,000 per year into policies. It's actually two separate policies. One's $300K per year, the other is $200K per year. And then we have the doctor I mentioned earlier who's funding a total of $1 million. And what we're going to look at are the annual yields, and then we'll also look at the taxable equivalent yield. I'll go over exactly how we calculate that. So let's begin with the hedge fund officer, shall we? So what we've got here are his policies. This is two of them combined. If we expand everything to the left, there's his Guardian policy, there's his Mass Mutual policy. And then we just have the combined values here. It makes it a bit easier. So what we can do here is first look at the annual yield, which is the net growth rate every year. His Mass Mutual policy has a dividend rate of 6.4%, and his Guardian policy has a dividend rate of 6.1%. The dividend is never what you're earning. It's not the net, it's always the gross. So the taxable equivalent, what we would do here to calculate this is, if you like Excel, equals whatever your annual yield is divided by the difference of whatever your tax rate is. So take 100 minus 40, that would be 60%. Hit enter. Look at that. So what this is showing us is in his tax rate of 40%, if he earns 2.29% in a taxable account, like a money market, after he pays taxes, he'd be left over with 1.37%. As the years pass, you can see that that tax-free yield becomes more and more attractive, which gives him more and more buying power. So again, equals your annual yield divided by the difference between 100% and your tax rate. So we have, what we did here is 60% because 100% minus his tax rate of 40% is 60% that you can see up top. What I like to do is this. So we'll take 100% minus the tax rate over on the far right. So this is actually based on the 40% up top. And watch this. If he says, hey, I'm not in a 40% tax rate, I'm not in a 40% tax bracket, I'm actually in a 30% tax bracket because I'm very creative and I know how to lower my tax rate, I would say, okay, let's do this. We can just adjust the tax rate and then our taxable equivalent yield automatically is updated, which is pretty sweet. So we've got the tax rate there. He's in a 40% tax bracket. Next, let's look at our Fortune 500 executive, and we're going to look at her actual policies. So she has a Mass Mutual policy and also a Guardian policy. She started them back in 2020 during the onset of COVID, during the pandemic, and she is 5 years into them. Her year 6 deposit comes up in September of this year. So like the hedge fund officer, we've got the combined values on the far right to make this a bit more simple. Let's do this. Here we go. All right. Look at those life insurance amounts. That's huge. So we can do the same thing here. Equals this divided by 100% minus, what is that, AE9. Voila! She is also in a 40% tax rate. Let's say that she's in a 25% tax rate. Is this still attractive? Yes. To her it is, at least. She's earning almost 5% annually, so there's not the average we see here, but that's the net annual yield year over year. And if she wanted to put her money elsewhere, she would have to earn about 6.5% with safety that life insurance carries in order to net that same annual yield. The thing is, she's in a 40% tax rate, which really makes it a no-brainer for her. And she is diversified. By the way, most people who do this are not putting everything that they have here. They're diversifying. She's got money in her company stock. She's got real estate. It's very common to see people diversify their assets. This is a safe bucket. And then lastly, we have the doctor and engineer couple. Check this out. So here's the policy that we are looking at as they are currently in underwriting. What we've got here is $300K, years 1 and 2, and then $100K through age 60 for a total of $1 million that's paid into the policy. Okay. What we see on the far left is just the design of the policy. So when we talked about maximizing it for cash value or setting it up for cash value of that $300K, a question I love to ask is, where is your money going? Base premium, here, we're setting it as low as we can. This is an example with Mass Mutual. And then we've got 90% going toward PUAs. In fact, very quickly, here's the illustration. Here we go. So cash value, $266,095 in the first year. By year 6, it's $1,063,000. Going back, 266, $1,063,000, exactly the same as the illustration we just saw. There's our annual yield. Again, this is with Mass. The dividend rate, 6.40%. That's gross. The annual yield is our annual rate of return. That's the net growth rate year over year. If we look at the taxable equivalent, let's do the same thing. Equals this divided by 100% minus this guy equals, check that out. Now, I don't think they're actually in a 40% tax rate. It's closer to 28%. But this is actually the same doctor that expressed frustration with having money in taxable assets that were safe. In her case, she talked about the treasury bills specifically because she's like, I'm paying taxes on this and I feel like it's even bumping me up to the next tax bracket. Whereas this, like, if I truly don't have to pay taxes on this as it grows, or if I access it through policy loans and it doesn't lapse, it's kind of a no-brainer to move some of my money here. And they're interested in it, one, for the safety and tax benefits. They also want to use it. Like they talked about using it for real estate. This couple is extremely disciplined, which I appreciate a lot. They've got a net worth of about $8 million and zero debt. So they've been very diligent in just paying their debt off over the years. But they're mainly interested in it for the tax benefits there. So overall, to summarize, why high income earners, wealthy families, small businesses, corporations, banks, and really anyone paying a lot of taxes is interested in whole life insurance is because it's a safe place they can put money. So call it a safe fixed asset. I see it go nowhere but up over time. And I also experience the tax benefit. If you asked, well, what's the drawback? Like, why would people not do this? If we go back to any of those policies, what didn't you like? Or what jumped out at you? Hopefully this, the negative hit in the first year. And what we see highlighted in yellow is the break-even point. So I start out behind and it takes time to recoup that loss that I take up front. That's the drawback. So someone who's very analytical will look at this, then compare that with putting money somewhere else and say, okay, if I have money in a money market earning 5%, yes, I have to pay taxes, but I don't lose any money. So let me look at a running total and see where I'm at 10 years, 20 years, 30 years from now, compare that with a life insurance policy. Rates are going to change. I need to factor that in as well, and then make a decision after they've weighed the pros and cons. That's typically what we like to do with folks. And then long term, they also have the death benefit, which is always paid income tax free. Death benefit proceeds, however, are not exempt from estate taxes. With all of that said, I do hope that this video was helpful. I'd love to know your thoughts, and if you'd like to see more videos like this, specifically where we are looking at taxable equivalents and such, if you would, feel free to leave a comment below. You can also DM me, and as always, I hope this helps.